And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Trying to get my chart fixed. Welcome to the show this morning. It's the day after the big sell-off yesterday. Of course, we were talking about this yesterday morning, as kind of the market was falling apart. Yesterday morning, of course, a very big down day yesterday. S&P was down 3% yesterday at the close. So again, a very tough trading day. But as we noted yesterday morning, we said, hey, be careful, with this open in the morning because we're likely to see some buying. And it's exactly what we saw. We saw a lot of stocks open down rather sharply. NVIDIA, as an example, was down 15-16% at the open. It still closed down about 7%, but recovered about half that decline. AMD actually went positive yesterday during the midst of that whole rout. But we saw a lot of recovery in stocks. Now, obviously the index still ended down 3%. There was still a lot of selling, but again, this is always important about why we don't want to kind of knee-jerk react to news headlines when they occur, because typically markets tend to do that. I mean, there's a lot of selling before the markets because of what's happening overseas, and of course those margin calls were happening yesterday, so things were being liquidated overnight. So again, by the time the market opens here, it's too late to do anything. So this is why we said yesterday, just kind of sit on your hands, be patient. Let's kind of see what happens. This morning, futures are pointing a bit higher. The Nikkei, which was down about 12% yesterday, is up 10% today. So, it's had a huge rally back. And of course, this is all has to do with that carry trade that we discussed at length. If you didn't see the video we posted yesterday, we posted on Twitter. We also posted on our YouTube channel. It's kind of pinned to the top of our YouTube channel right now. But Mike and I got on for about 10 minutes and just discussed what is a carry trade, what is it, how does it work, and what does this mean for markets. Today's post on the website, also, if you go to realinvestmentadvice.com, I just posted an article a few minutes ago talking about the same thing, the yen carry trade. What is it? How does it work? And how to navigate the market. So we kind of lay out some rules for kind of what happens next. And again, like yesterday, today's before the bell commentary is going to be a little bit longer than normal, just because I want to go through some technical levels with you as well, just kind of what to expect next. One of the things we did say yesterday is that bonds were very overbought, and we could see basically some selling in bonds if ISM came in stronger than expected yesterday. So ISM Services did come in stronger than expected yesterday. We went from contractionary to expansionary in one report. So the reason that ISM Services is important is that's about 80% of the economy is services now. So while the manufacturing numbers continue to remain in recessionary territory, services aren't. And given their big input into the overall economy, that suggests that fears of economic recession short term are probably off the table for right now. It also doesn't really put the Fed into a position to cut rates more aggressively than maybe a 25-point cut in September, because the economy and employment, now while the employment number was weak, and the one thing I haven't seen a lot of people talk about is that employment number was heavily impacted by Hurricane Beryl, which came through Houston. We had a lot of layoffs, temporary layoffs because of that, and that weakened that employment report a good bit. So again, while that number was still weak, we were still over 100,000 jobs for the month. So again, not recessionary on a lot of different fronts. So again, we got to be careful to extrapolate. Now, the one big risk to the economy is consumer confidence. And if this market correction continues to decline, and I do think there's some more downside to go, as I'll say in a second, then that could impact consumer confidence, and that could weigh on markets a bit. We'll talk some more about that, and we're going to write about that more in this weekend's newsletter as well. So here's what you need to know before the bell. So yesterday the market sold off again. We talked about yesterday morning. we are trading well into 3 standard deviations oversold right now. Even though the market bounced off the lows, we still finished down about 3% yesterday. But the market is very oversold on multiple levels. So again, kind of looking at where we are, the question is kind of what happens next. So the most logical kind of moves for the markets right now is going to be a bounce here short term because we're so oversold. Again, going into this, remember in June and July, we were talking about a 5 to 10% correction. While this has been very sharp, we are only down 8% from the peak. So we're still within that very normal correction process right now. If we travel down to the 200-day moving average, we're going to be right about 10.5% by the time we get there. And I do think that's a likely outcome of this. But before we get there, we're very likely, because of this deep oversold condition in the markets and the fact we're deviated so far now below the 50-day moving average, that we're going to get a correction. Now, kind of a reflexive bounce. The problem here is that we've got 2 very big gaps in the market at the moment that are going to have to get filled before this correction process is over. So again, we've got a good bit of work to do here in the markets. And the problem with these big sell-offs is that they occur so quickly that a lot of people don't have time to react. So there's a lot of investors that are trapped in this sell-off and they're panicking here and they want to get out. These are called trapped longs. These trapped longs are going to look for any type of rally to start selling into. So very likely we're going to have an initial rally potentially to get us back to kind of where we were a couple of days ago, which isn't a lot. But we get a rally to this level and potentially we have some more selling that comes in. Outside of that, the other set of resistance is going to be this previous bottom. And that just messed up my chart doing that. So that's going to be this previous bottom that we had at this other gap. So we have these 2 previous gap levels to fill. So a rally to that level, a decline, or potentially if we get a stronger rally, that's certainly possible. But I think once we get to those kind of levels that these trap longs are going to look for an exit to get out of the markets, that's going to lead subsequently to a retest or a test potentially of the 200-day moving average. And that's going to get us back down to again, a level where I think we finally wash out all the sellers. And again, this may take another week or 2 or 3 before we get there, but we'll kind of wash out all of the sellers and allow the markets to kind of get back on its feet. But again, for right now, and this is kind of the rules that we go through in the article today on the website, is the rules to kind of navigate what comes next. Use rallies here as an opportunity to reduce risk and rebalance. We talked about that kind of ad nauseum going into this peak. I kept telling you, rebalance portfolios, reduce risk, etc. And y'all were emailing me and saying, why do you keep saying this every day? The markets are just going up. This is why. When this happens, it happens very quickly. And if you don't manage your risk along the way while the markets are going up, it's very difficult to do when you're in the midst of the sell-off. Now, one other thing that we talked about yesterday was bonds. And I said yesterday, take some money potentially if you're trading bonds, great opportunity to basically, take some profits here. Not surprising. Bonds actually did okay yesterday, but after that ISM Services number, we lost some of those gains. But we're very, very extended right now above the moving averages here. So again, a decent pullback in bond prices won't be surprising here because we're so very extended. So again, a bit of a rally in stocks, a bit of a takeoff in bonds won't be surprising. Yields up today because of this, as well as stock prices up today. So again, we'll see a little bit of that reversion process starting today. Okay, that's what you need to know before the bell this morning. We'll be back, pick up with John Penn, lots of stuff to get into, lots of client questions yesterday. We'll talk about those next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Of course, John Penn joining me this morning, as he often does on a Tuesday, because he has nothing better to do. You know, last week when John was here, we were talking about, how old we're getting and talking about correlations to things that relate to how old we are. And one of the other ones is that now we're so old that when Brent ever dresses up for work, it's generally because somebody died. So...
I walked in this morning, I was like, oh no.
No.
What happened?
He's like, well, no, the slacks are tan. So now we know how to tell the difference. If the slacks are black, it's a death. If it's slacks are tan, he's got a meeting. So
what color pants is Brent wearing today? That's a great segment right there.
Has a lot to do with what's going on. But yeah, you got to go through that phase of your life where all your friends are getting married, so you're always having to dress up to go to weddings. And then you get to our age, and it's like every time you dress up, it's our funeral. So
it's like, you're not wearing your flip-flops today, John. What's going on? I know. Or I should say Crocs. I think Danny just passed out. Sorry,
yeah.
Danny. Throw Crocs in there.
So anyway, all right, look, lots of stuff to get into and lots of questions from yesterday, of course. I want to put a couple of things in perspective for you because this is where, we make all these emotional mistakes. And again, we talk about these emotional biases that we have because we're all human and we all have them. But, the headlines yesterday were interesting. NASDAQ, Dow down 1,000 points, NASDAQ down 1,000 points. Never before in history, the market was, NASDAQ was down 1,000 points. We were down more on an intraday basis during the pandemic. We don't remember the number of points, right? But we can remember the big sharp declines that we had, right? We're down 5% in a day, those type of things. Well, it's because the NASDAQ is a lot higher in price than it was back in 2020, and it's a lot higher in price than it was back in 1980. The point though is that never measure outcomes. And yes, 1,000 points is like, wow, 1,000 points. But how much are we up, right? How many thousands of points are we up since the 2020 lows? Nobody's talking about, the Dow's, the NASDAQ's up 3,000 points, 4,000 points, whatever it is. And yeah, we're down 1,000. I get it. 1,000's a big number. And, this is a great headline. I got a ton of phone calls yesterday. It's down 1,000 points. What does this mean? Is this the end of the beginning of the end? No, you're down 11% from the peak on the NASDAQ. On the S&P, you're down 8% from the peak. So, we talked about previously that in June and July, we had this conversation on a regular basis, and y'all were emailing me telling me to stop saying this every day. I get it. But we're going to have a 5 to 10% correction, right? wrote about it in the newsletter. Said, market's very extended from long-term means. We're very deviated from long-term means. We're very overbought on multiple levels. Bullishness is way too elevated. Household allocations at all-time highs. We had this conversation, and we talked about managing risk, taking profits, rebalancing portfolios, those type of things, right? You do that, as I said, because of these events, right? You can't do those things in the midst of the event. This is the opportunity where if you've done that work, you can now start looking around for a shopping list of things to buy. And this will pass, right? Now, having said that, could this be the beginning of a much deeper correction? Could this be the beginning of a 20 or 30% decline in the markets that, trigger a recessionary response? Sure, it's possible. Recessions are driven by consumer sentiment. So if this market downturn continues and starts to weigh on consumer sentiment, yeah, we could see a much weaker economic environment going forward, potentially a recession. That would cause earnings to have to be reevaluated, and that would cause a reversion in valuation. So sure, this could ultimately lead to a much deeper correction in the market. Do we have any evidence of that at the moment? No. What we have is this unexpected exogenous event that we discussed yesterday in Japan, this unwinding of leverage, which, by the way, is $20 trillion altogether. It's not small. Now, does that mean we have to unwind all of that leverage? No. We just have to unwind enough of it to kind of set things right. Are we done with that yet? I doubt it. The issue of the yen carry trade, as we discussed yesterday, and again, if you don't understand it, I don't want to go back through the whole discussion today, but there's a video pinned to the top of our YouTube page right now. There's also an article on our website explaining it. So again, kind of more of the detail. But the thing about a yen carry trade is that the unwinding can create an ongoing cycle of that unwinding. So as leverage is, in other words, as these margin calls require selling, then the selling occurs, which reduces the margin, which requires more selling, so forth and so on. So today we're seeing a bounce in the Nikkei, and some of that pressure is alleviated, but I doubt we're done at the moment with this process. And that's why I think there could be a little bit more downside here. Now, are we going to go drastically lower because of this? Who knows? We don't know. That's when we have to kind of navigate it as we go. But there's certainly some risk there we got to pay attention to. But if markets stabilize, then this will pass, and we'll start going back to focusing on earnings and other things. Another bonus for the markets right now is that 82% of S&P 500 companies are now out of their blackout period for buybacks. So you now have lower prices on corporate stocks, much better opportunity to deploy buybacks here than it even was just a couple of weeks ago. So there is a buyer standing by waiting to buy stocks in size. So there's a lot of reasons that this market could stabilize. It doesn't mean it's going to go straight back to all-time highs. I'm not saying that at all. But there is certainly room, with the market as oversold as it is right now, for a decent bounce. Now, what do you do with the bounce? As I said, if you haven't been taking any action, if you've been just kind of sitting on your portfolio, not paying attention, use the rally to start reducing some risk. Use the rally to rebalance your portfolio a bit. Don't make drastic changes. We've talked about many times before, investing is a game of inches, small changes. Don't go liquidate your entire portfolio because your NVIDIA stock is down, right? Whatever. Just small changes. Things that you're really overweight on or were overweight on, maybe not anymore. Reduce those back to target weights. Things that you're underweight on might be an opportunity to start adding a little bit to them, right, after this market correction. The world's not going to end, though, is the key point here. This is an event that occurred. We'll get through this. It'll pass, and then markets will start to recover. How long that takes is the unknown. We don't know how long this will take. It could be sloppy here for a while. Again, we have the election coming up right around the corner in November. So September tends to be a weak month seasonally, just especially in pre-election year. So we still have that risk sitting out there as well. So I could keep these markets fairly suppressed over the next month or two. In other words, it could just be, as I kind of wrote about last weekend, we could be seeing a kind of a replay of what we saw in the summer of last year, where we went August, September, October, 3 months of this market just grinding lower for 3 months. We didn't have this sharp sell-off last year, right, which is going to change things a bit, but just, 2 or 3 months of this market not doing a whole lot, it's going to be very frustrating. It's like, man, I'm not making any money. Nothing's happening here. That's possible. So we need to be ready for that. And this is why, raise some cash levels, kind of have an emergency fund set aside so that you don't have to draw out of your portfolio if you don't need to, particularly as we go through this process. This will end, and the market will rally again, and we want to make sure we're in a position to be buyers at the right time, and we'll get there. So again, just let's not overreact. And again, we kind of went through a lot of this analysis yesterday, but again, markets are very oversold here. This bounce right now, the Dow's up about 260. NASDAQ futures are up about 1% right now. So we're going to have a nice little reflexive rally this morning. Not going to recover what we lost yesterday by any stretch of the imagination, but I would be starting to use this rally even today to start the process of kind of reducing risk in portfolio. John, good morning.
Good morning.
How are you?
I'm good.
So I'm sure you got lots of phone calls yesterday.
Kind of had a couple questions come in yesterday. Yeah, actually, it was a pretty busy day with conversations. And, I think when you take a step back and you kind of have to frame this a little bit, markets are down. You mentioned earlier the Standard & Poor's 500 index is down in this most recent pullback, from kind of the middle of July till now, a little over 8%. And again, as you've made several comments before, in any given year, a 5 to a 10% pullback in the market, that's kind of normal behavior, right? That is not to be unexpected. Right. That
happens every year.
But markets can get pretty complacent. Investors can get pretty complacent. Look at the VIX until recent. I mean, the spike in the VIX, the spike in volatility as of late has been like a straight line upward if you look at that, right? Right. But you look at that and you say, okay, markets are down 8.3, 8.33%, give or take. And it just feels a lot worse than what it is, right? I think yesterday it was, the headlines are just getting folks a little unwound a little bit, right? So the media is still steering the narrative, is what I'm saying.
Right, and that's gonna be happening today as well. But again, there's a lot of other things that are going on. I want to talk about some of the economics that's happening right now as well, because there was a lot of conversation yesterday. Is like the sell-off was because of recession fears. That wasn't the case, but we'll talk a little bit about that. Recession risk have gone up just a smidge, and we'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult.
There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Now, I warned y'all about the chat rules. Our chat member, Jerome Powell, says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
The Real Investment Show podcast.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, that was back then when men were men.
We liked it.
At realinvestmentadvice.com.
Had blubber for days.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. Just kind of looking at the chat on the break. Joey asks, says, do I ever talk about gold? That held up nice yesterday. It did. Gold did not go down as much as the market yesterday, which is good. Yeah, I don't talk about gold a whole lot, Joey, because it's a commodity, right? So it's a chunk of metal, and it doesn't have fundamentals, doesn't produce an income stream. It's a very heavily manipulated market on a lot of different fronts. So it's pretty much a speculative asset. And so as long as the prices are rising in gold, then you can trade gold. And gold has been doing nicely. It's been kind of having as of late, over the last several months, it's kind of been a very volatile uptrend. It rallies and has a pretty decent sell-off, rallies, has a decent sell-off. And so that's kind of continuing on because right now there's a bid behind gold because, and a lot of this came from the carry trade as well, as gold prices are rising, it kind of sucks in speculative assets. So that it drives, because again, commodities are all driven by futures trading, and commodities on the futures market are very heavily leveraged assets. So again, it's the options prices on the price of gold, et cetera, that drives the price of gold. So there's not a whole lot to talk about other than just the technical. It's not a currency. I hear this a lot. People go, oh, no, it's a currency. No, it's not a currency, because if it was a currency, you could spend it. If you have to take something, anything, right, whether it's Bitcoin or gold or whatever it is, if you have to convert it from whatever form it's in to a currency, it's not a currency. The whole definition of a currency is that it is an acceptable form of trade. I can walk into Starbucks, buy a cup of, and this is the litmus test for it, is can you take that asset, whatever it is, walk into a store and buy something with it? Can I walk into Starbucks and buy a cup of coffee with it? If you can't, it's not a currency, right? Stocks aren't a currency. Bonds aren't a currency because I have to convert them back to dollars before I spend them, right? So once you strip out kind of all the narratives from people that are trying to sell you gold in the first place, they have an inherent bias, obviously. Then you really come down to, I own a chunk of metal and I'm hoping it goes up in price. So and if that's the base premise, then that is simply a tradable asset. So you trade it as a commodity, and when it's going up, you own it, and when it's going down, you don't. And there's nothing wrong with that. There's nothing wrong with trading commodities. I have some friends of mine that are fantastic commodity traders. It is way too risky for my blood. I'm too conservative as an individual for that. We do have a portfolio that we run in our shop called our all-weather portfolio. It owns gold in it. So we're not anti-gold, right? We have a portfolio that owns gold in it. So but again, just as a function of the world in general, we talk about the markets, we talk about economics, we talk about those things that are moving the most money in the world, and that's the stock market for the most part, the bond market for sure, because it's even larger than the stock market. That's where money moves. So Joey, to your question, yes, if you have a specific question about gold, happy to answer it. Put it in chat. Happy to answer your question for you. But in general, we don't spend a lot of time on gold simply because we're not trying to sell you gold products. We don't. It's not our job. We're here to manage money and grow it long term.
Now, and so talking about gold a little bit, I mean, there are a high number of individuals and families that I visit with on a regular basis that do have an allocation of gold or silver. They have like an allocation to precious metals.
Absolutely.
As a diversifier. It's part of their overall investment portfolio, right? And I can see in times of market stress when things are a little bit more volatile out there, hey, it is nice to be able to put your hand on it and touch it. It's real, right? It's there, right? Mm-hmm. But to your point, you have to think about, well, how are you approaching having gold or precious metals in the portfolio? Mm. Like you mentioned in our all-weather, it's just a piece. It's a diversifier. Yep. It's not like it's 40 or 50% of the overall portfolio. And if you're out there, there are a number of you that I visit with where you are stockpiling gold because you are waiting for the time to go down to your local grocery store and buy a loaf of bread with it, mm-hmm. right? You
better have a gun with you when you do that.
Yeah, gold and lead, right? Because if that's the time and I see you pull out a hunk of gold, okay, let's go. But so it's all about that perspective and how you approach it, right? So all great points, Lance.
Yeah. Well, another thing too, a comment is gold. Long-term holders, it's an asset that holds its value. Stocks have way outperformed gold in terms of being an inflation hedge over time. So gold is fine. It does hold some of its value relative to inflation. It didn't in 2022 is a good example. During when we had 9% inflation, gold was falling in price. So obviously did not act as an inflation hedge when you needed it the most, right? 9% inflation. Over, a couple of decades, it has done okay. Over the long term, it's vastly underperformed other assets in terms of holding its inflation value. But Max brings up a very good point. If you're going to own gold, don't buy gold bullion. Buy coins with a numismatic value to them, collectible gold coins. And the reason is that gold itself, gold bullion, can go up and down in price. But if there's a coin with a numismatic collector's value to them, right, you buy those. Those hold their value much better because there's this collectible value to that, right? Those are going to continue to hold value regardless of what the gold price does because it has that collector's value to it. So if you're going to own gold, the best thing to do is to own coins that have a collectible value to them. And those will even do better than just the price of gold itself over time. So anyway, it's all fine. Again, if you own gold, awesome. Absolutely nothing wrong with it. You own a commodity. Just understand what you own and why you own it. And this is the most important thing. Again, my problem with most of the gold narrative is that it's being pushed by people to scare you into buying gold. And, the world's going to come to an end. You have to own gold. Think this thing through, right? If the world comes to an end, there's no guarantee that gold is going to be the barter issue. because people don't have it. So if people don't have gold in general, like if 300 million Americans don't have gold in their house, they're not going to barter with you because they've got nothing to barter with. And, they can sell you a sheep for your gold, right? That's great. But in a time of economic demise, like they're promoting in a lot of cases, it may be bottle caps that people are trading and not gold. And so all of a sudden you've got an asset with no value at all because nobody wants it. So again, in that moment of economic demise, what's going to be the most valuable asset you have? That's going to be the ability to protect your family, right? So it's when we talk about own lead first, then you can protect what gold you have, right? That's the most important thing. So again, just, the fear mongering to sell you a product where they're making a commission today is important to understand as with all assets, right? We talked about private equity recently. We've talked about owning stocks. We've talked about owning IPOs. We've talked about all these things. Always ask the question, a couple of questions actually. Why am I so lucky that you're offering this to me? And B, how does it fit into my portfolio? Do I even understand why I own this thing or for what reason it is? And when am I supposed to sell this, right? It's great to own it, but if you don't convert it back to dollars at some point, the value's not there, right? So there you go. All right, enough of that. Anyway, so go ahead.
Yeah, so one of the points you just mentioned was one of the questions that I received yesterday where somebody that I was visiting with was a little frazzled, to say a little stressed out with the latest market action. It was because they really didn't have an understanding of what they owned in their portfolio, right? And the advisor that they're currently working with, they haven't taken the time, or at least the client, that particular person that I was visiting with, felt like the advisor had not taken the time to adequately educate them on what they own, why do they own it, and what's the strategy, right? Now, at the same time, sometimes phones do work both ways. It's like, well, have you asked your advisor to explain this to you, right? But let's take a step back and really examine, why do you own what you own? So, because sometimes I hear, well, I don't understand. I don't know why I even have this, John. I don't even know why I have this in my portfolio. Whether if it's a certain type of mutual fund or if it's like, I know we were talking about annuities not too long ago. And when you don't have a good grasp on what your underlying securities are in your portfolio, and then you get this market volatility and the media is just knocking at your door, markets are down, stocks are getting crushed. Well, no wonder why you're stressed, right? So sometimes you got to just take that step back and you kind of got to get your hands dirty. You get in there and just kind of figure out, okay, why do I own this? Does this make sense for me? Like Lance just mentioned. And, if I am taking on too much risk after I do a deeper dive into the portfolio, okay, well, now what am I going to do about it? Right.
Yep. So anyway, not to get off on the topic, but again, the question's good. Again, we try to cover all, and when a certain asset is moving in one direction, I mean, if there's something big going on around a certain asset class, Bitcoin, whatever it is, we'll talk about it. Lately, gold has been pretty boring, so there's not been a lot of reason to talk about it as of late. But obviously a carry trade blow up gets headline attention, and that's what we're talking about right now. But it's a great question. Again, we're always we want to help you with your investing as you go. And again, what assets you choose to invest in, that is solely up to you. There is no right or wrong investment, right? You can buy and sell anything you want in your investing portfolio, and that's completely okay. We have to understand the rules around why we own it and how to make money with it. Because again, at the end of the day, that's our job. We're trying to take current dollars and turn them into something else, more dollars down the road. But that only occurs if you sell the asset at some point. And so that's the rules we have to follow for all assets, whether it's gold or stocks or bonds, whatever it is. In fact, talking about bonds, we'll come back and pick up with that on the other side of the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. All right, getting ready to wrap this up. Man, they went by fast. Couple of things. As we talked a little bit about yesterday, bonds very, very overbought in the short term, and I kind of noted yesterday, too late to buy bonds. We've talked about buying bonds previously on the show and the reasons for owning bonds, in particular, in the moment of a market crisis. They act as a hedge, and that's kind of exactly what we're seeing right now, and that's how they worked yesterday. And really the last couple of days, bonds have done very well in holding up portfolios because they act as that natural hedge for volatility and for fear. However, as I discussed yesterday, I said, look, bonds are very, very overbought. Interest, yields have gone down sharply, and so, expect a retracement of that. That's what I'm saying. I said yesterday, don't buy bonds here. A strong ISM number, which we got yesterday, would certainly kind of pull those bond prices back. And yesterday morning, bonds opened up about twice as high as where they ended. And so we saw a strong open in bonds as that kind of initial knee-jerk, action of the market happened. Then ISM hit, and we saw yields come back a bit. So again, and that's kind of expected. It's just they're so overbought. Where stocks are very, very oversold, bonds are very, very overbought. There's been a direct non-correlation over the last couple of days, exactly as there should be, by the way. So this morning, yields are creeping back up to about 3.84. We got down to about 3.73 on the 10-year Treasury yesterday. So decent little retracement between yesterday and today. We're still below 3.9, and very well we could creep back up to 4.1 in the next week, month, whatever it is. I do suspect that bond yields will pull back towards. There's a whole cluster of moving averages right now, all sitting on top of each other, which are going to provide really, really good support now that we broke through all those things very decisively. A pullback to that support level will be a better buying opportunity to add bonds to your portfolio. It's not too late to buy bonds for your portfolio. Just don't do them today. Again, just very, very overbought. They're going to correct or at least consolidate some to some degree before we get a further move higher, and that will correspond with slowing economic growth, lower inflation, those type of things, as we've discussed before. Interest rates on bonds are very sensitive to economics. Now, importantly, we're talking about Treasury bonds, not corporate bonds, and specifically not high yield bonds, because high yield are junk bonds. Those are the same thing. That's an interchangeable term. High yield is marketing for Wall Street to sell you junk bonds, which are companies on the verge of default. Those spreads are actually blowing out. We're actually seeing now for the first time a decent increase in the yield spreads between low quality and high quality bonds. Not a tremendous surge just yet, but we are starting to see those yield spreads widen for the first time in a while. And as we've talked about before, the thing we want to watch more than anything else is credit spreads. Credit spreads tell you everything there is to know about the markets. When those credit spreads start to widen, in other words, yields on junk bonds are going up and Treasury bonds are going down, where they're going in two different directions, that tells you there's financial stress, not only just in the markets, but potentially economically as well. We're very early in that phase, but this is what you would expect to see if indeed the economy is slowing down and we are going to see potentially a recession at some point in the future. That's not going to occur today or next week. I saw a lot of headlines yesterday, John, of the sell-off is because of recession fears. No, this was all the yen carry trade, right? The risk of recession has gone up mildly because of yesterday, because of the impact to consumer sentiment. This certainly woke people up. And all of a sudden, people make this decision. It's like, wow, I just took a beating in my portfolio. I better not spend any money this month until the market comes back. And so they cut back spending. That feeds into slower economic data. So we could see that. That's why the recession risk upticked a bit yesterday between credit spreads and between what's happening with consumer sentiment. We could see that risk of recession creep up here a little bit and kind of start to weigh on markets and really more importantly, earnings outlooks, which is what drives markets. Go ahead, John.
So a little bit more on bonds, and you were talking a little bit about, possibly adding some more bonds to the portfolio. Very timely point there, because that was a question I received yesterday where somebody was maybe wanting to add a little bit more longer duration. And we're talking about bonds, Treasuries, because if you look at the yield on the Treasury as of late, earlier this year, kind of back in April, the yield on the 20-year U.S. Treasury was just below 5%, 4.94. And now we're sitting down at about a 4.21. So really over the last couple of weeks in this equity sell-off, those long duration bonds have added some really nice lift to the portfolio overall, right? But then the question yesterday was, well, has the yield moved on the Treasury downward so much? Hey, John, have I missed the opportunity? Right?
Well, and look, this is always the problem. Right? Nobody wanted to own, when we were buying bonds last year, nobody wanted to own bonds, right? That's the issue. Everybody was convinced that yields were going to go surging through the roof, and inflation was going to be this everlasting being with us, from now to eternity, and so nobody wanted to own bonds, particularly in duration. But we laid out the case multiple times as to why bonds will play their role, particularly after being in a bear market for 3 years. That's that's the longest stretch in the history of the bond market, going back to 1780, that you've had 3 negative years in a row. So again, it was just a function of time until bonds start to come back into their own in terms of an asset class. And I think we're finally there. We're definitely starting to see that. But again, just on the short-term basis, they've kind of run away from you. So they will come back. Yields aren't just going to go straight down unless we literally wake up tomorrow and we see headlines like, oh, we're in a recession and the Fed cuts rates by 150 basis points in 2 weeks, right? Then yields are going to go down much more quickly. Yields will fall as the Fed cuts rates. That's how this is going to happen. But it's going to be a slow process. So again, just be patient here. You're going to get a better opportunity to add some duration to your portfolio.
Yeah, and so you were talking about spreads just a moment ago. I think that's a really key point. I don't think a lot of people understand. Okay, you're talking about, hey, these spreads are widening. That's a key thing to watch for if credit spreads are widening as maybe an indicator that we are getting into a more recessionary environment. And you were talking about the spreads between high yield or more speculative corporate bonds versus treasuries. And so the thought behind that is, if folks are concerned that we're getting into a slower rate of growth or a more recessionary type of environment in the U.S., that they're going to move away from or sell those could be more speculative corporate bonds. Prices come down on those bonds, yields go up, right? There's a flight to safety, so they are buying treasuries, thus driving up the prices of those treasury bonds, thus driving those yields down. And that's what is causing the spread to widen. Is that correct?
That's correct.
All right.
Right. Again, when the economy slows down, earnings slow.
Right.
And for instance, small and mid caps. That whole rally in small and mid caps is now gone, by the way. That got wiped out in 2 days. But again, 40% of those companies are basically non-profitable, right? So if you own corporate bonds and small and mid cap companies, they may seem okay right now. But if we get into a slower economic environment where earnings grow and they're already non-profitable, the concern is going to be, can they pay their debt off?
Because that's what they survive on. They're surviving on debt.
Correct. And then, of course, what happens is that when that concern of a recession and economic slowdown, slower earnings growth, then all of a sudden everybody begins to question, as is always the case, every corporate bond. Will ExxonMobil be able to meet their payments? Intel just slashed their dividend to zero, right? They just cut their dividend. They're laying off 15% of their workforce. They have fundamental problems. So those corporate bonds are not where you want to be. And if there becomes a slower economic environment that really begins to impact corporate earnings across the board, concerns about debt repayment are going to go up. So those yields rise as a function of the risk of repayment starts to become a concern. I don't have that risk with treasuries. So treasury yields fall. I sell my corporates, and unfortunately what happens is it's kind of baby with the bathwater. We sell everything. So corporate bonds go up in yield. Treasuries go down in yield as money rotates from risk to safety.
That's it.
Yep.
Just the world of bonds. I mean, the bond market's actually larger than the equity market, right? And it's still a lot of the questions. We all get a lot of questions around equities and positioning portfolios from a stock standpoint, but it seems as of late, I'm getting more questions still about bonds, and it's just still such an enigma. Or bonds are there's just a lot of unknown in that space.
Well,
right?
there is, because it's a bigger market than the stock market. It's the lifeblood of the economy, and we don't spend any time talking. We talk about Apple, Google, Chipotle, we talk about the stock market, we talk about Bitcoin, we talk about gold. We don't spend any time talking. You watch CNBC, they never talk about bonds, right? The great thing about bonds is if you can learn the basics of bonds, which is super simple. Bonds are very simplistic to understand. They're not complicated. The great thing about a bond, though, is the moment you buy a bond, you know exactly to 1/100th of a cent what your return will be in the future if you hold it till maturity. There is no other asset in the world that you can do that with. So this is why, and bonds act as a great hedge in your portfolio. They help create income. They help lower volatility. They're kind of like spinach. Everybody hates spinach, right? But it's really good for you.
Especially if you put enough butter on it. It's good.
Well, you just kind of killed the whole benefit of it. But
Sorry.
yeah.
Olive oil, is that better?
That's better. Hey, thanks for watching the show today. We appreciate you very much for joining in. Be sure and like the video and subscribe. We appreciate it very much. That video yesterday that Mike and I did on the yield carry trade on the homepage of our YouTube channel right now. Also, that article on the website now, realinvestmentadvice.com, with the rules to kind of navigate whatever is going to come next. A little bit of rally today. Will it stick? We don't know, but we'll pick up and talk about this tomorrow. Danny Ratliff will join me as well. Have a great day.